I really appreciate the opportunity to share my views on community banking with all of you. But just as importantly, I look forward to your questions and our discussion following my talk, and I'm sure I'll learn a lot from those. Today I'm going to spend most of my time talking about the state of community banking, especially here in Minnesota, and then I'll conclude with some thoughts on the country's economic performance. Before I begin, I want to remind you that the following views are my own and not necessarily those of my colleagues in the Federal Reserve. Now, as I said, I'm going to talk about two topics, community banking and economic performance. And this pairing is natural and important. What happens in Main Street credit markets has a significant influence on the broader economy. Community banks are an essential credit provider for Main Street. Community banks have the skill and the knowledge to evaluate borrowers who, because of their size, activity, or location, are relatively costly for an outside firm to evaluate. As a result, community banks facilitate economic activity that would not otherwise take place. The individuals and businesses who receive credit from your banks are key components in both the local economy and in the national economy. They produce valuable output and provide numerous jobs. When I come back to talking about economic performance, you'll hear that that output and jobs are key and central concerns of the Federal Reserve as we seek to promote maximum employment and price stability through our monetary policy choices. Now, when I talk about community banking, I'm going to make four main points. The first is that community bank recovery from the financial crisis has been strong with regard to asset quality, but earnings and loan growth have lagged. Second point, lagging earnings and loans have raised questions about the cost of new post-crisis supervision and regulation. Third point is that low earnings and higher regulatory costs have also raised concerns about community bank consolidation and its potential acceleration. And finally, in response to these concerns, and as a matter of prudent public policy, I strongly support tailoring supervision and regulation to reflect the risks and roles of community banks. So I'll now describe these four issues in more detail, and then, as I say, later turning to talk about economic performance. So let's first talk about community bank conditions. Community banks in Minnesota and in the nation as a whole experienced a very sharp increase in problem loans during the financial crisis. Fortunately, that trend has now reversed. So one way to do this is through a very standard measure or metric of problem loans, the ratio of non-current and delinquent loans to bank capital, and the allowance for loan loss. In the first quarter of 2009, that ratio for all loans rose to 24% for the median Minnesota bank. 24%. That was double the 25-year median level of 12%. For commercial real estate loans, that problem loan ratio rose to about 9%, 9 times higher than the 20-year median of 1%. So that's where we were in the first quarter of 2009. That story, that problem loan story, has changed completely. The ratio for total loans is at 9.5% for the median Minnesota bank, right around the 25-year low. And the ratio for problem commercial real estate loans for the median Minnesota bank is at 2%, still elevated, but it's returning rapidly to pre-crisis levels. And these same general patterns that I've described for Minnesota apply as well for the nation as a whole. So that's on the problem loan front. The low earnings and negative loan growth for the median Minnesota bank have also improved relative to the heart of the crisis, but we're not back to pre-crisis levels. So if you think about one standard measure of profitability is return on average assets. It's been holding very steady for the past several years at just below 1%. Now, this is clearly better than where we were at the trough of the crisis, when return on average assets fell to 0.5%. But the 20-year median is 1.15%. So where we are now, which is, I said, slightly below 1%, we're right now at 0.94%. That, just to give one way to think about that in terms of context, we looked back across all Minnesota banks over the past 20 years and looked at all the return on average assets, and that number, 0.94%, is in the 19th percentile. So across all those observations, only 19% of them are below that 0.94%. 80% are above that 0.94%. So that tells you 0.94% is low relative to where we've been historically over the last 20 years. So year over year, net loan growth for the Minnesota median bank is at 4.6%. Again, this is much better than where we were at the trough of the crisis, where it was minus 4.7%. And indeed, negative growth persisted through the end of 2012. So that's the good news. We're back to 4.6%, and we were having negative loan growth all the way through 2012. But the 25-year median is nearly 6% for Minnesota banks. So that would be where half the time you're above and half the time you're below. 4.6% is at the 39th percentile. So again, looking across all the banks over the past 25 years, only 40% of those observations, 39% of those observations, would lie below 4.6%. So again, we're not back to historical norms. The nation's banks show similar patterns. So I've been focusing for obvious reasons on Minnesota, but if you look at the nation's banks, you see similar general patterns. So what's the summary on all this? There's been recovery in important ways from where we were at the depths of the crisis for community banks in the state and in the nation. But important measures of bank health continue to lag historical norms more than 5 years after the depths of the crisis. Just to level set and reframe everything in people's minds, the recession, the Great Recession, is generally dated as having started in December of 2007. The financial crisis associated with that Great Recession is often dated as having started in August of 2007, when some large banks started to face funding issues. The recession is dated as having ended in June of 2009, and unemployment peaked in October 2009 at 10%. So here we are, almost 5 years after that unemployment peak, over 5 years after the end of the Great Recession, and as I said, important measures of bank health continue to lag historical norms. So when you look at that weaker than hoped for performance on profitability and on terms of loan growth, this is one factor that raises concerns for community banks about the additional supervision and regulatory burden that faces them post-crisis. So I now want to turn to talk about those concerns. So low earnings levels have many potential sources. So let me talk about 3 of them. On the revenue side, weak loan growth naturally leads to more competition for the available loans and drives down returns. Second, if banks can't make more loans, they typically replace those loans going off their books with securities, and those securities usually earn less than loans, again, lowering bank returns. Finally, and I suspect this will come up later, interest rates are at very low levels, and that compresses bank margins. Now, so that's on the revenue side. So those are reasons why revenues would lead to low bank earnings. But of course, earnings are also impacted by costs, and so higher costs can also reduce bank earnings. And it's clear that the costs of complying with bank regulation and supervision are increasing. Since the financial crisis and the 2010 Dodd-Frank Act, supervision of community banks and the entire banking sector, and I'll emphasize that again, and the entire banking sector has become more intense. This is not a transitory change being driven by banking conditions like weak asset quality. Instead, it represents a recalibration of risk management expectations by supervisors for the entire banking sector, but in particular for community banks. And I see those higher expectations continuing to spread across bank operations, and meeting these higher expectations will increase bank costs. So this is all qualitative, and I was a professor, as Harry mentioned, for many years, a professor of economics, and economists want numbers, so it's not enough to just talk in this qualitative way. So to what extent has additional supervision regulation raised costs, reduced earnings, and shrunk profits? This is a question that's difficult to answer with precision, but we have gone after it. My staff has gone after this question at the Minneapolis Fed. And our analysis indicates the reductions to profitability could be material, especially for the very smallest community banks. So here's one way to talk about this. Our estimates suggest that if you look at banks with less than $50 million in assets, if they had to increase staff by half a person to deal with that increased regulatory burden, their median reduction in return on assets would be 14 basis points. If they had to go up by 2 employees to deal with that increased burden, then that median reduction in return on assets would be 45 basis points. So that's starting to be. Anyways, there's obviously a large difference between those numbers, 14 versus 45. Reduced returns on assets can encourage capital flow away from the banking industry. And indeed, bankers routinely raise concerns with me about the potential for more regulation to drive consolidation in the industry. And that's the topic I'll now turn to. Yeah, so I've talked, to return to my 4 points, I've talked about the current state of community banks and where we've come post-crisis, and then I've talked about how increased supervision and regulation is increasing costs and for our smallest banks in a quantitatively material way. Now let me turn to talking about consolidation. The number of community banks in Minnesota has been falling for some time. If you go back to 1980, at that point in that year, there were 760 banks chartered in Minnesota. Now, as of the first quarter of 2014, that number is less than half that. It's 341 banks are chartered in Minnesota. So that's over a 34-year period. Now, one concern that I've heard from many is that the rate of decline will rise as increased supervision and regulation depress earnings. So I focused on some quantitative measures whereby we talked about the increase in employment necessary to deal with increased regulation. But many bankers also tell me about intangible costs, arguing that some new compliance requirements also distract them from serving customers. These soft costs could also drive bankers to exit the industry. When you look at this decline from 760 to 341, my concern is with, the further decline from below that, my concern is with the public policy aspect of this matter. It is possible that the evolution of information technology may have increased the returns of scale in banking. As a society, we should expect and welcome consolidation as a response to this natural economic force. But there's a policy concern. The policy concern is if the negative benefit cost of regulation or supervision drives out banks that would otherwise effectively serve customers. So you look at that downward trend in the number of banks, if it's being driven by technology, from a social point of view, from an economy's point of view, this is what the response that you would expect and indeed welcome. But it's coming from undue regulatory burden. That's a concern. So this is a very hard question to sort out. How much of it is coming from what? What we've done at the Minneapolis Fed to get after this question is to look at the post-2010, the post-Dodd-Frank supervision regulation and what effect that's having on the pace of consolidation. So to help determine if new regulations and supervision introduced since the financial crisis have led to more rapid consolidation, the Minneapolis Fed is estimating future consolidation of banks in the United States and 9th District states based on historical trends. So we go back, use the historical data, look at that trend line, and see to what extent we're hugging that or consolidations proceeding more rapidly than historically or less rapidly. And why are we doing that? Well, if consolidation exceeds projected rates, that might suggest that new supervision and regulation has changed the dynamics of banking and banking consolidation. Now we're watching this, and so far, over the last 4 years, it's a relatively small sample, the rate of recent consolidation of Minnesota community banks has remained consistent with historical patterns. We continue to monitor this. This is, we're only talking about 4 years so far. Continue to monitor consolidation rates relative to forecasts in order to be able to detect changes that are not readily attributable to the forces that were applicable before 2010. And our website contains quarterly updates to these forecasts if you want to go online and look at that. Now, so this is all about just looking about the recent data, but both bankers and policymakers are concerned about the long-term health of community banking, not just next year's numbers. How many community banks will exist in 10 years? Now, I have no way to answer that question with certainty, but I can offer a few perspectives. If historical patterns were to continue, that number will fall considerably. If we just look at the historical trend and extrapolate it forward to 2024, 10 years from now, there will be just 263 banks in Minnesota in 2024, a 23% decline from where we are right now. Now, we could assume that there would be a slower rate of consolidation, 14% decline. And why would we do that? Well, the rate of consolidation was slower from 1995 to 2005. So there was that one 10-year window in over the last 30 where consolidation did slow down markedly. But even so, we would still fall from 340 banks where we are now down to 293 banks. This is crude modeling. We've done more elaborate statistical modeling of the potential long-run decline in the number of banks in Minnesota. And that statistical model is based on historical movements of banks into and out of different asset groupings. Some banks get larger, move from one size bucket to another. Other banks exit the industry altogether. This is a much more elaborate, fancier model, a transitional model. And we use that to forecast the number of banks in Minnesota 1 year out on our website. If we roll those forecasts forward, it suggests the number of banks in the state will fall to 282 in 10 years. So this is, just to recall, I talked about two different extrapolations you could do from where we are, from where we are now. And those extrapolations took us to 340 down to 293 in the best case, or 260 in the more pessimistic case. This more elaborate model got us to 282. So where we had, all three of these estimates predict that the number of banks will fall sharply. The number of banks in Minnesota will fall sharply over the next 10 years from the current 341 to a number in the high 200s. Now, if you're looking across all states, this is focusing only on Minnesota. If you're to look across all states, across all 10-year periods since 1985, the median decline would be a little larger, actually, than what we had in Minnesota. I was focused on a decline of 23%. It'd be about 25%. So you'd have a little more of a decline than some of the estimates we provide. But again, you'd be in that high 200s range. All these forecasts are only estimates, and they should be interpreted accordingly. The actual number of banks may turn out to be smaller, but indeed, it may also turn out to be larger. Okay, so this is I've talked through the health of community banks. I've talked through some of the cost burden associated with regulation and how that might be materially affecting small institutions in particular. And then I've been talking about some of the past trends in consolidation in the community banking in banking more generally, I should say, in Minnesota. I want to turn to my final community banking topic, which is about tailoring. And I've already noted it's a matter of considerable public policy concern if regulations, not market forces, are the prime cause of bank consolidation. Federal Reserve policymakers have recently discussed how better tailoring of supervision and regulation to community banks can be helpful in reducing the extent of this problem. Now, the Federal Reserve does some tailoring already, but I think we should do more. I'll mention two examples of the kind of tailoring that I have in mind that are already in place, and I'll turn to two additional steps that we could consider. So let me talk about safety and soundness first. The Federal Reserve and other agencies received excellent comments from community banks in the Basel III proposal. These comments led to changes in the proposed rule that reduce unnecessary burdens on smaller banks. Smaller banks can opt out from having their capital levels vary due to changes in particularly volatile aspects of income. The final rule also allows smaller institutions to continue to count certain types of stock or securities as capital, whereas large banks can't. I think this is an example of the rulemaking process working well. Issuing a preliminary rule and receiving comments from bankers allowed the final regulation to better address the actual risks being posed by community banks. So that's on the safety and soundness side. On the consumer side, the Federal Reserve has moved to a more risk-based, risk-focused, I should say, exam process from the less flexible previous approach. The new framework allows our examiners to better tailor their exams to the consumer risks that a particular bank may actually pose. Many banks that the Minneapolis Fed supervises don't engage in activities that pose a high risk to consumer protection. Many have a strong documented record of compliance and relatively little change in operations. Under the new framework, examiners can more readily eliminate certain areas of review. Now, the benefits of the new consumer program go beyond a more focused scope. The new framework also encourages more of our supervisory work to occur off-site, thereby reducing the on-site burden that we impose on community banks. Now, at the same time, where there are potentially risky activities, the flexibility in the framework allows for a deeper dive into those activities. So I think this is exactly, it epitomizes the tailoring that we need, this new consumer exam framework. It's based on an analytical approach aimed at improving supervision, and it captures institution-specific details where appropriate. So that's two examples, I think, where tailoring has worked, is already in place, the tailoring of Basel III, and then also the tailoring in this that's embedded in the new risk-based approach to consumer supervision. Where can we engage in additional tailoring? So Governor Daniel Tarullo has noted potential benefits in reviewing statutes that apply new regulations to all banks. Community banks may not create the risk that a specific regulation addresses. In that vein, he noted the so-called Volcker Rule and the Dodd-Frank incentive compensation requirements. I strongly agree with Governor Tarullo's point. Congress and supervisors should exempt all community banks from certain regulations. Exemption is the best way to guard against regulatory trickle-down. Not done. It's a second fruitful approach. It's a very unusual thing to have somebody applaud during a Fed speech, I have to say. Welcome, though. Welcome. Thank you very much. Yeah. A second fruitful approach to additional tailoring consumes supervision, not regulation. I worry that our current supervisory methods establish expectations that are too detailed across too many areas of bank operations and too wide a swath of banks. There's an alternative. Supervisors could concentrate on a smaller number of activities that we believe are correlated with bad outcomes. For example, supervisor could focus on rapid loan growth, high lending concentrations, specific high-risk types of lending, and wholesale funding strategies, and then skip some of the more detailed reviews. This kind of shift in focus would generate higher returns to society. It would generate higher, improved safety and soundness per dollar spent on supervision, as opposed to detailed work programs. Now, I'm suggesting a tailored approach, something for community banks, so the supervisor could certainly retain the more comprehensive, proscriptive approach for larger, systemically important banks. Now, I offer these ideas, these latter two ideas, as not as final prescriptions, but more in the spirit of open inquiry. My main point is that we need to further investigate ways to tailor the supervision regulation of community banks. Okay, so the remainder remarks now I'm going to turn to the country's economic performance. Now, you might be worried. Don't worry. I'm not going to talk as long as about the economy as I did about community banking. What I'm going to do is, since I'm a member of the Federal Open Market Committee, the FOMC, that means I'm a monetary policy maker. So my discussion about the economy is going to be framed by the goals of monetary policy. Congress has charged the FOMC with making monetary policy so as to promote price stability and maximum employment. And I'll discuss the state of the macroeconomy in terms of these goals. So let me start with price stability. The FOMC has translated the price stability objective into an inflation rate goal of 2% per year. This inflation rate target refers to the personal consumption expenditure, or PCE, price index. This is a little different from the CPI, the consumer price index you usually hear about. The main thing you want to take away is this is a measure of inflation that's based on the rate of increase in the prices of all goods and services, including food and energy. So when we think about our goal for inflation, it's not stripping out any particular goods and services. Now, if I look at that headline rate, that rate of increase in the PCE price index, that rate over the past year currently stands at 1.6%, which is below our target of 2%. In fact, if you go back to December 2007, the beginning of the Great Recession, the inflation rate has averaged 1.6% since that date. And inflation is expected to remain low for some time to come. So if you look at the minutes from the June FOMC meeting, they reveal that the Federal Reserve Board's staff outlook is for inflation to remain below 2% over the next few years. In a similar vein, earlier this year, the Congressional Budget Office predicted that inflation will not reach 2% until 2018, more than 10 years after the beginning of the Great Recession. And I agree with that forecast. So this just means that the FOMC is still a long way from meeting its targeted goal of price stability, keeping inflation at 2%. Now, the second FOMC goal is to promote maximum employment. So what then is the state of U.S. labor markets? If you go to July, the latest unemployment rate was 6.2%. And this number is representative of significant improvement in labor market conditions that we've seen since October 2009, when the unemployment rate is 10%. And I expect the number to fall further through the course of the year to around 5.7%. But the progress in the decline of the unemployment rate masks continued weakness in the labor market. So we've seen improvement in the unemployment rate, and we're going to continue to see improvement in the unemployment rate, but it does mask continued weakness in labor markets. There are many ways to see this continued weakness, and I'll mention two, though, that I see as especially significant. First, the fraction of people who are aged 25 to 54 are prime-aged potential workers. The fraction of those people who actually have a job is still at a disturbingly low rate. Second, a historically high percentage of workers who would like a full-time job can only find part-time work. So that fraction of people who would like a full-time job but can only find part-time work is still at a historically high percentage. So I continue to see labor markets as remaining some way from meeting the FOMC's goal of full employment. Now, I've told you that inflation rates will remain low for a number of years and that labor markets are still weak. It's important, I think, to understand the connection between these two phenomena. I've talked about this in greater detail in recent speeches, that a persistently below target inflation rate is a signal. It's a signal that the U.S. economy is not taking advantage of all its available resources. If there was enough demand in the economy to push inflation back up to 2%, those underutilized resources, that demand would make use of those underutilized resources. And the most important of these resources is the American people. There are many people in this country who would want to work more hours, and our society is being deprived of their production. Now, as bankers, you know all this too well. You see this underutilization of resources in your own communities. I began this talk describing the important link between what you do as community lenders and what we strive to achieve at the FOMC, which is to put the economy's resources to work. The FOMC's low interest rate policy in recent years has certainly provided some challenges for banks. But the committee's ultimate goal is one that we share with you: a stronger growing economy that benefits all. And on that goal, I'm sure that we can all agree. Thank you once again for the invitation to join you here today. I look forward to your questions.